right, stocks broke out today, gapped up to the upside, started the week strong. We're going into a very important earnings week. Really good rally. We got some positive technical signs today, including some really strong outperformance in the Russell. So we're going to break down what it means, and we'll see if we've seen a similar pattern of really oversold. Maybe not as much as we've been oversold, but we've gone from a strong oversold condition to a strong overbought condition rather quickly. From oversold signals, overbought signals, and what happened there in the past. I'm going to break that down. I'm going to break down too some interesting developments in different asset classes and how they're performing relative to each other, including equities, including gold, going back to a point of time where we've had where before a lot of volatility came in before the Great Recession. So I'm going to break that down in today's, and then we're going to take a look at a trade idea today for a stock that has earnings coming up. How do we trade it in a low risk way that gives us good reward and keeps our risk really low if the stock doesn't move as we think it will? So let's go ahead and get started. Today is Monday, April the 27th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's go ahead and get started and take a look at the S&P 500 with the market forecast indicator. We finished without an overbought cluster here, but came really, really close to getting an overbought cluster again at the beginning of an intermediate trend, which is interesting. We'll kind of break that down here in just a second. Or at least break that down from an individual stock perspective here in a minute. But to go from an oversold cluster to an overbought cluster in a matter of just a few weeks, it's, again, you'd have to kind of go back to the last time we were really, really significantly bearish, and we got multiple overbought clusters, and even that didn't get, we were straight shot up too, all the way up to this level, and even that didn't get an overbought cluster at the very beginning of the trend. This is probably about as close as it got right here and right over here. You can see how we got established and then we got going again. So that just kind of shows just how significant. We all know how there's another oversold cluster that did not turn into an overbought cluster, even though it was a straight shot up on that intermediate line. You have to go back a little bit further. Again, just going to go, where is the other one? Maybe the 5-year chart. To go back to the oversold clusters that produce the intermediate pullbacks. We saw that one there, and of course that one started the bearish move instead of ending one. Here's oversold clusters, and we rallied straight up to the upside and did not get an overbought. Got right back up to old highs, did not get an overbought cluster. Over there, obviously it didn't end. Here's an oversold cluster that turned right into an overbought move, and that's the last time. And this was the first fall of 1915, and we had the subsequent fall in 1916, right? So that's kind of a keep that in mind here. That this was great. We rallied all the way back up to old highs. In fact, if you take a look at it on the long-term chart here, and let's go to a 5-year daily chart, this to kind of give you an idea of what that 15-16 period looked like. We got all the way through the 200-day moving average, getting us up to, we weren't as far below, but we got pretty decently below. We made a nice good run there. Look at that, just about every day. This is a Hakinyashi candle, but still, just about every day we rallied up to that overbought cluster. Well up above, actually it was a couple. This was, I think the first one was over here, and then we got the second overbought cluster. We hit these old highs and we kind of stagnated at this level, kind of hit this at a resistance level and stagnated. In fact, if you take a look at the market forecast chart, again, go back that same 5-year period, and you can say, okay, all the way back to 15, 16 right here. So you can see the first one was at 10, 16, 15, and the second one was at 10, 23, 15. So about a week apart. If I go over to the Bollinger Bands, I take a look at the Bollinger Bands, the volume profile on 10, 16, 15, when we got the first cluster. If I can type, go back a year before that, so we'll go back to 10, 17, 14. There we go. So this is what our cluster looked like. In fact, let's get rid of the probability of expiring cone that's throwing us off. That's what we look like. Again, going into the first cluster. Kind of looks a little familiar to what we're seeing right now, as you'll see here in just a second. And of course, once you look at the second cluster we got was 10-23-15. So go back to 10-24-14. This is the second cluster that we got, and look how much closer we got to. Didn't quite get to the point of control, but got right back to that resistance level. And again, you look by the end of the year. And this was 15. By the end of the year, so there's 10-23. Excuse me, here's 10-23. We finished going up into that point of control, held it, and then you can see, and obviously we all know what happened going into the beginning of 2016, right? So by the end of February of 2016, so that would be March 3rd of 2015. That's what ended up happening, right? We hit that point of control. We made a strong run from below, from being below the value area, not to the same, obviously, percentage-wise extent as we saw, but made a sharp rally up before, and again, pretty darn bullish, well above the 200-day moving average at the time. And then we came all the way back down, right, within a few months, back because there's no volume down here below. So you can see by the time we got to, what would that be, 12/31/15. Let me go back to there, and you can see how little volume we had below us. 12/31/15 to the beginning of the year. Just how little volume, and once you break through that level, then it's down to the downside, and that because of that volume. So very similar to what we're seeing here. The point of control we're kind of heading in towards. A first cluster where we're close to a first cluster where we're hitting that big volume area. The point of control is right here at about 299,300. And then again, not as much volume down below, so much easier to come eventually back down. So, again, now if you break through that point of control, great. And again, the possibility of that happening is, there is a pretty decent probability of that happening because it already has happened on QQQ. Now, QQQ didn't fall as far below its point of control like SPY did, right? It was already it was so far above it that we had dropped all the way down to it and has since bounced off of it. So that's a little different than SPY, which wasn't as far up above, but you can see now has changed. That point of control was so far below. And of course, IWM, which has such a good day today, up almost 4%, trying to fill in that volume gap, right? If it makes that volume gap here, then we're moving towards 300 and SPY. In fact, this is kind of a little bit of a breakout that would suggest that that's a pretty likely scenario to happen, that we could very well get a repeat of fall of 2015, where we made a very strong move to the upside. One thing to kind of keep in mind, again, about this breakout pattern is we still haven't gotten above 60 and stayed there. We haven't even gotten above 60 on SPX. QQQ has gotten above 60, but can't quite stay there and didn't get back up above it here. And IWM, which has been lagging, has just barely gotten up to where it's close, and neither one of them have gotten over to 200. Now, some individual stocks have, but not the broad markets themselves. You take a look at their DMI patterns, too, to say, okay, are we getting some good DMI patterns here on SPY, as bullish as we are? And you notice we are still between that 25 and 30 area, where we look bullish. We haven't really gotten going yet, kind of what we talked about before. And the negative directional index is barely below 20. It's actually forming a higher low point on there. As of right now, of course. You take a look at the, what was the other one? The Ichimoku cloud. And you say, okay, we did break, we're almost at 2.5. We are above 65. And we are flirting with breaking through the cloud. So, there is some element of, we can really kind of make that move up towards at least 300 if not beyond, right? Because we are getting almost a moderate. Now again, you look at IWM and it's still actually on a bearish trend, and it's not through its cloud yet. But you look at QQQ and it's on a strong bullish trend, right? We went from a strong bearish trend immediately to a strong bullish trend through its cloud up above 5, up above 80. So we can kind of see the gap in performance here that's kind of driving the market, and the S&P is kind of caught in the middle. Which one do we follow? Do we follow the strong NASDAQ 100 companies that are highly concentrated, as we all have heard and know about? Or do we follow the Russell? Is the Russell finally going to come up? Or was this a new thing? Is it a one-day phenomenon that we outperformed by so much, by 4%, 4 times the return? Or is that a kind of blow off? Because if you look at its returns here lately, to get a 4% move, where is it? It is this one here. If you look at its returns lately, you notice this is one of the biggest moves that it's had for a while. It's all the way back here. Here, let's get rid of those. Here we go. So we can see a little bit better. But you can see, we had this bullish move here. We've had a few of these bullish moves, and you can see what kind of comes after them. So, we'll see if this is a one-day phenomenon that turns into a lasting bullish trend, or if this was kind of a bullish blow-off that turns into some red candles, red bars on this histogram chart that has typically followed the bigger green bars that we've seen here recently. Now, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video here if you're watching us on YouTube. That will notify you when these videos are posted. Hit the thumbs up icon that's down below the video as well. That tells us two things. Number one, you liked your video. And number two, that you want us to do it again tomorrow. If you don't want us to do these videos, then you don't have to click on anything. But if you do like these, you want us to do it again, you want to let us know, you can do it with one click right now while you're watching. Also down there, comment. What did you get out of the video today? It's always fun to see the comments, see what you're getting out of it. I appreciate the different perspectives. And if you have any questions or comments for me, that's the place to go. Join our website at marketscholars.com. There's a link popping out in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow us on Twitter for more content in between these videos from day to day. You can see my handle up there at DavidSettle42. And then join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog here, check out some of these other things. We do a Market Outlook live video every day. There's a link. You just click on this icon here. That will take you to that page. It's also in the menu right underneath Market Outlook. If you click Market Outlook Live Trade Review, we go over all the other trades. We also invite you to check out our classes. We do 8 classes a week, not including the 2 online coaching sessions that we do for our premium subscribers. But both our monthly and our premium subscribers get access to all of our trading rooms. If you follow our Twitter account at marketscholars.com, you can see Brandon put together a really nice image here that describes all of the classes that we have. So check that out. Again, it's at @market_scholars. Follow that account if you haven't, but you can also see our classes there, a description of all our classes. That's our calendar, and click on here. And again, all of our monthly subscribers get access to that, and you can subscribe and cancel at any time. So for those of you who want to check it out for a month, you can get access to all of our upcoming classes, as well as archives for all of the classes we've done over the past couple of years. All right, back to the charts, and let's take a look at the long-term chart. And here's another relatively good sign. Again, remember there's 2 things we watch for on the Hakinyashis to maintain this bullishness. In this case that we're getting right now, and it's great to get above the 50s. I mean, granted, the regular candle, you can see, we're not out of the woods this week, so we need to hold this little breakout that we've had and not come back down the rest of the week. But from a Hakinyashi standpoint, there are 2 things you look for: a higher close and a higher high. And it'd be ideal if you close above the prior high. So those are harder to do. But if you can get a higher close and a higher high, then that's enough to maintain the trend. And so far so good on both those accounts. Now we're one day into it, but so far so good. We just need to stay above 28.19 for us to maintain a higher close, and we need to stay above 27.66 to maintain a no lower shadow. That's kind of a third thing. So higher high, higher close, no lower shadow there. If you take a look at the 3 green arrow chart, you'll notice we have 3 green arrows. So, and the momentum is starting to pick up, but don't put a whole lot into that momentum. Again, going back to that 5-year period, when you get strong momentum, I mean, this is one of the strongest momentum moves that we've had, but it's also one of the biggest momentum drops that we've had. The ups mimic the downs typically. If you notice, the momentum swings mimic each other. So it's not, it was as big of a move as it was to the downside. It's not surprising to mimic it to the upside. But you notice that when you get, a strong move, we get a big move to the downside followed by a strong move to the upside, then you notice we just don't get a lot of momentum after that, right? We kind of go up and down a little bit, and you notice we're still upward, but it's just really, really slow. Go back to that 1915 period right here. We got the strong momentum, and it was not a very big. See, we had the big selling here, and then kind of some ups and downs before we got that overbought cluster in this area right here. 1016 and then going into that 1023 periods where we got the other cluster. But then you notice not very much volume or momentum at all. It was hard to maintain momentum until you had the second leg to the downside. You got a strong momentum to the upside and then very little momentum until you had an intermediate pullback. So don't expect to maintain strong bullish momentum because we don't have, remember, it mimics what you've got on the downside. We haven't had a negative momentum. So if we're going to come back up again, it's not likely, especially with volume. I mean, look at today's volume is the lowest that we've seen now. Already back down to 77 million. That's just, very, very, again, go back to that 2015 period in between these periods. You can see we had a big jump in volume and we came down, but we didn't drop so far. And we got the second leg lower. We didn't really get as low down, but we didn't get the average to get as high either, but we have dropped considerably lower. I mean, just like that, down to 77 million. That's a big time drop in volume. And so, again, that's how falling momentum goes. You are still above the 8-day moving average. The MACD is still above its moving average. Stochastics is crossing back above its moving average. And again, another idea that we talked about before that I'll remind you is when you have lower high points, it's not common for us to grind like this. Again, go back to the 2015 time frame here, right over here. So this was a relatively lower low, but you see we grind for a while and then we rolled down. We actually got a higher low point form before the lower high didn't grind, right? We didn't grind, and that was actually kind of an equal high there, and the point of control was really close to the top of the value area, really close to 52-week highs. So a little easier to grind here, but then once we got the lower high point, we didn't, right? We rolled over pretty quickly on all of these lower highs. This is a lower high point. Lower highs typically don't grind. We are heading into a resistance. There is, especially at 300, there's where the point of control is. So we can grind into that area, but as we saw before, strong resistance levels. That's where that 15 bounce met its ceiling, was at that point of control. All right, now let's take a look at the intraday moves. So you'll see the new high tag, and we talked about kind of like, okay, that rubber band's pretty expanded, so it'd be nice if we can get a high tag further, closer over here as this eventually moves up. The width of this range will keep us from pushing too far up to the upside, but if we can kind of flirt with the highs and get new high tags so that when this does move up, it doesn't, this high tag, was kind of threatening to move over here to the left. That's not necessarily a good sign to have both the high and the low tags over here on this side. So it is good to that we got a little bit of a high here. And again, just keep in mind that the width of this channel decreases the opportunity for us to go up too high, right? We got up to about we went up about a buck. Was at 287.30. We got up to 288.30. So we expanded the rubber band by $1, and we formed a new gap, a new common gap. And there's still that common gap that we haven't filled in yet from April 21st. Never mind this gap that we still haven't filled in yet from April the 6th. And of course, we go back even further, and you have the March 24th gap, which we consider to be a runaway gap that probably won't fill in now on any successive move to the downside. But you can kind of see, with this rubber band is stretched, what are the reward risk ratios going from here. Our reward is represented by the lower. I mean, you can still go up, and we got the 300 ceiling. We've got the stretched rubber band that will take a few days to not be so stretched, but still, even at these levels, is relatively stretched. That will limit the reward. The risk is filling in that gap and that gap, and then of course eventually that gap. But at least in the next week, this gap and this gap, that would be your risk for the upside reward. So keep that in mind as we contemplate bullish trades like we have been doing last week, like we will today, and how much you lean bullish in your active trading account. It's one thing to have nothing but bullish trades on, but it's another thing to say have some bullish trades mixed with the bearish trades to take advantage of this move, as you'll see here again as I go into some individual stocks here later. So we talked about the volume at 78 million shares, the lowest that we've seen during this rally. Which makes sense, right? The volume, keep in mind there's a gap, and the ATR now has fallen below double digits, so it's back below 10. But you also have the gap of 282.97 to 284.62, so almost a 2-point gap. So you have to add on. You're still well below the average on the volume. So if you look at the ATR and the volume, still falling, but still not below the 3% mark. Right? Remember, the 3% mark is usually after we hit the 3% mark is when we form the low point. So that's something to keep an eye on too. It's one thing. That's the difference. That's the biggest difference between now and 2015, where we had bounced up off of this. We never did get. See, the ATR only got to 2%. That actually acts as a resistance level. So that kept the bottom from being so big. And the second time, we also went up to 2%. Also kept that bottom from being as big. This is different in that it got up to 6%, which is rare for us to get these highs. And when we have gotten this far above the 3%, usually we form the low point after we hit 3%. Usually not before, especially on the not on the actual peak. It's very rare for us to actually form the low point like this on the peak of the selling on the low point. And you can argue whether that was the low point, if this was, or excuse me, whether that was the initial thrust of selling. This is the initial thrust of selling there, where the HR took off, and then that was the retest that bottomed out. Right, just like this would be the initial selling here, and then that was your retest. You can see the initial selling here, and then that was your retest, and then here's your initial selling here, and then that was your retest. Well, here's the initial selling. And again, usually when it's been this big, and we've seen it in other instances, but the most recent has been 2008. We don't form the low point until after we hit the 3% mark. So something to keep an eye on as we approach that level now, this go around here, especially with the volume as low as it is. You can see going back to, again, 2008, the volume had also fallen. By the time we had gotten the 3% mark, you can see the volume, the average volume here, had fallen to 254 from about 500. We were up to almost 500, down to 254. So the average volume almost got cut in half on that initial drop down to 3%. Well, if you look at the average volume here, it didn't quite get up to 500, but it got up to 300, close to 300, and we're already down to 150. So the average volume has already been cut in half as we approach this 3% level. So kind of important to see as we're hitting that, especially as we're hitting that point of control. And then finally, an interesting pattern. On Friday, we really dipped on the VIX. Today, we dipped a little bit. We dipped down here at the beginning of the day, and we dipped below the 95% into the neutral area. So it kind of we're hitting some lows in volatility relative to where it's been in the past. So I mean, it's over here it wasn't really low. It had dropped down considerably, but it was still really high compared to back month. We finally dropped below 100%. We're back into the neutral territory for volatility. Breaking below 90% starts the bullish trend. But holding it, as we've seen in the past, again, go back to our favorite time to compare. When you came down in here in this 2000, let's see, that was 2015, you can see how he's jumped up. And then before we had made that bounce up, we had dropped down into that bullish territory, into the neutral zone. But of course, the more apt comparison is this model where we jumped up a lot higher than we did in 15-16, as you can see. See, there's 15-16, and there's this jump. So we jumped up. We had the bigger move. We came down. We were holding. We actually did drop below 90% at the end. Oh, that's 2011. Sorry. Here we go. That's the one that we're looking at. Much bigger comparison. So we came down, and we did hit that. We did dip into the neutral zone a little bit at the end of the year before we hit the low point. So, is that kind of move coming here? Again, that one went to a lower low, and we don't have to go to a lower low. We might just go to a higher low. But is that kind of move coming after the type of drop that we've had to get to this point? You can see, I mean, we had a similar drop there. We went from 80 all the way down to high 30s. We hit 37. Well, here we hit 80. Didn't stay as long up there, right? This was like a double top here at the 80 level, but we have come down to the low 30s now in this case, and we'll see if that ends up holding as a support this go around, where it was a resistance on all these previous peaks in 15 and early 18 and at the end of 18. All right, before we look at some other charts, I want to summarize this technical outlook, and we've got some nice, some good bullish signs. Obviously, we have a good trend, a good rally off these lows, but we still don't have like the confirming, that we're not going to ever come back down again type signals. We have some things that look like we are that will make you think that we're really bullish, but we haven't crossed through some key thresholds and some of these indicators like the CCI, like the RSI, like the VIX, and things like that would say, okay, here we go. We're not, if we come back down, it will just be little near-term pullbacks, not necessarily new intermediate pullbacks. We've seen in the past where we have had what looks like a strong rally off of a big low point below the 200-day moving average, even getting above the 200-day moving average, but getting to a ceiling that was unable to get through, and and where it looked like we would never come back down again, we ultimately did. And so the question is whether this is going to be similar to that time frame, or whether this is going to be like, say, end of 2018, and other periods where we got a cluster. As of right now, you'd have to consider the former, because we're lacking the strong bullish confirmations across multiple different algorithms that make up the different indicators. So what do you think? Do you agree with that? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click on that link. It opens up a poll, and then you can let me know. If you click disagree, comment down below as to why. What are you seeing on your chart, or what indicator are you using that would tell you that we did get that bullish confirmation, or that you're even a lot more bearish than even I am, that not only are we going to come back down, but we're going to go well through those low points. If you see something that would suggest that, share with us down below what you're seeing there too. All right, so an interesting chart that I posted on Twitter, and it might be easier just for me to show you that than recreate it here really quick. But I showed it. It was on my Twitter that I posted earlier today, so make sure you're following me for that. But this is a chart from the peak in 2007. So this includes the Great Recession, right, where we fell down as much as we did, 50 some odd percent. You can see all the different color lines. The green line is QQQ. Now, including this 50% drop in QQQ, including that, at the beginning of this run, QQQ is up 300% in this, 12-year period roughly. So that's about 25% a year to get to that point. That's a really, really good return. You come down, you say, okay, well, is there anything that's pretty similar? Oh, this yellow line. Well, the problem with that yellow line is that's not the S&P 500. That yellow line right there is gold. Gold had a really strong rally. It got back up to those highs here right now. It's actually back up to the highs it had during the credit downgrade, during all the QE and the credit downgrade and the renewal of QE3 that kept it up high. Now, once we got into QE3 and we ended QE3, it actually fell. Gold fell. It didn't fall as far as it was pre-crisis levels, but it fell. And then since then, it's actually been rallying. Remember, 15 and 16, we had that kind of double dip, a death cross going into the beginning of 18, where again, I believe that we started this bear market that we're in right now. It's been well above those highs ever since. Of course, we talked about before how this move on Qs kind of masks that bear market. But again, since the beginning of 07, look at EFA and EEM. Both of them have been sharply lower. I mean, well, relatively sharply lower, down a few percentage points a year. But they didn't really recover. They recovered as best as they could, but they never got above break even. And then again, they had a really good run here in 16 and 17 off of those initial low points after about a year plus of declines there. And then again, that's where the bear market started, and they are well below those highs. So those areas never really recovered. The third best asset class here is bonds, long-term bonds. You can see how they held up pretty well during the Great Recession. Then they stayed pretty stagnant and actually rallied into Operation Twist into the beginning of QE3. Then QE3 kind of settled things down, and then by the time it ended, we had another big rally in there right before the election. Right before the election, bonds were right there with gold, but also right there with QQQ. And then the election came, and we had a good run in stocks, and bonds fell down to not the October peak, or the January 18 peak, but the October peak. That's when the second wave of bearishness hit. The first wave hit internationally in January. The second wave hit even bigger in October. And you can see from that October 18, bonds has been on a pretty much straight shot to the upside, even though stocks have been relatively flat. And QQQ is actually higher than its October 18. So it's interesting to see the performances. This is small cap stocks, which for the most part rallied, outpaced the S&P 500 most of this time until lately. It was lately that the S&P 500 has had a nice, good, strong. I mean, look at the purple lines pretty much above this whole time, this whole rally, which is what you want to see, right? You want small cap stocks. I mean, that's the engine of the economy. So you want them to have good performances, and then a little bit of a drop by 16, but then they rallied back off of that low point, a little bit of a drop again where they came back, and then after that, unlike all these other periods where it bounced up and pulled away, it bounced up but did not pull away. In fact, it was S&P that pulled away because of these QQQs, and now we have a gap divergence that only has widened here, about 34 percentage points on this chart, and of course significantly against Qs. So that kind of tells us a little bit about the health of this long bull rally and what is now kind of trying to keep it afloat, where all these other risk asset classes are telling us otherwise. Now again, that doesn't mean that we can't be bullish. It just means that we just have to really monitor reward risk ratios. The rewards that we get to the upside can still be positive, as we see with QQs that we've seen over the last few weeks. But the risk of that too, how have we seen things recover, those divergences play out in the past? Well, it's played out to the negative, right? So we just have to account for that risk, where even if it never plays out, compare that to the reward we have going forward from here based on what these charts and these relationships are telling us. Let's take a look at how these different foreign markets are doing. U.S. again, some really kind of positive developments. China, nice positive move. Italy still lagging behind. India lagging behind. Brazil really lagging behind. So we're getting some strong trends looking just like the S&P. But again, like all the rest of these, we've gotten up. We've had the initial bounce. The U.S. has since kind of, has had a kind of an upward tilt. Everything else has been kind of a sideways tilt. Sideways, 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 sideways. After the initial bounce, a little to the upside, but sideways, really sideways. Never really did get initial. They stopped going down. And then Russia, a little bit of an upward tilt, and Korea the same. And Korea, remember how important that is from a global economic trade and a global economic growth proxy. So good signs, kind of nascent signs of being bullish, but not necessarily confirming signs that, okay, I mean, none of them are giving us the overbought clusters yet at the beginning of these bullish trends that would say, okay, these kind of the stamp of approval. That overbought cluster at the end of a trend can signify exhaustion. At the beginning of a trend, it signifies approval, right? Kind of a stamp of approval that we are bullish enough now to keep this going. All right, so on the sector standpoint, it was interesting to see what led us up today. I mean, look at all these strong returns. I mean, look at small caps, which has been the laggard, right? Big time move to the upside. And you look in the S&P, look at all these consumer discretionary companies, all leading the way. Again, you can see the hotels and the cruise lines and Gaps and the Nordstroms and the Macy's of the world. In fact, I looked at this, I pulled up this relative strength chart. This is the chart of all of these stocks. This is their relative strength chart relative to the broad market as a whole. This is the market leadership right now, today. This was today's market leadership. As we head into that resistance, it's these stocks that are all moving. So this is a graph of relative strength that measures stronger relative strength to the right and stronger momentum in relative strength, so gain or loss in relative strength on the left. So as you go up, you're getting strong relative strength momentum. As you go to the right, you're getting strong relative strength. So you put those two together, this is the best one to be in. This means that we have negative relative strength and we're gaining momentum to the downside as we go to the down here. So that is a worst possible quadrant. And that's not surprising. That's where these are the top 20 stocks that went up today. The only two that aren't in the red, that aren't nearly as bad, is Laboratory Holdings, which is flirting around where the S&P is. The S&P is right smack dab in the middle, and how it's performing. So you can see Quest Diagnostics is outperforming, and it's got a little bit of momentum, but you can see how it compares to the rest of these. And Laboratory Holdings is really kind of matching the market exactly, and not really, and a little bit of positive momentum occasionally, but and this would be over the last 10 weeks. So you can see this is actually since the beginning, from the peak and then the subsequent rally. That's our winners, right? That's our leaders today. Those are our leaders. That's on a weekly chart. This is what they look like when you look over the last 10 days, so the last 2 weeks. This is their chart. Again, they've had strong momentum to the upside. All of these have had strong momentum to the upside. You can see now they're all rolling down. There's some of them have some strong relative strength. Royal Caribbean, MGM, not surprising. Viacom, but you see all of them are coming down. So is this a one-day phenomenon on a trend of relative strength that's falling on a daily basis that is extremely bearish on a weekly basis, or is this the start of something new? Right, where we can say, okay, here we go. Like, we are really, these things are going to keep us going to the upside now. So, according to these chart patterns, my guess would be the former. These are really horrible stocks to be in, according to the weekly chart. From a relative strength standpoint, horrible charts to be in. And even in the last couple of weeks, they haven't been good stocks to be in. And today, whether or not that halts the trend. See, usually this pattern goes up and down. It's like a circular pattern. If I were to kind of pop this out so you can see a little bit more of a circular move, here, let me center it, and then I'm going to animate it. You can see how these are all the same stocks, but you can see how they have a circular rotation to their relative strength, how they go up to the right and then down to the left and then back up to the right and back down to the left. It's a cycle. Right, these stocks all cycle with each other, and even as the market was really bullish, they were kind of up and down, kind of matching the market as a whole until you got to the market peak. Some of them are already pretty bearish, but you see how they all really cycled down, and then they've rallied, and then now they're cycling back down again. And again, usually we don't cycle down and back up. We usually come down to the left, up to the right, down to the left, up to the right. So again, is today's move going to alter the down to the left that they're kind of in the middle in? Or is it just kind of a sucker move where we say, oh man, this looks great, and we're really kind of breaking out, and here we go. So, again, that's when you look at like their charts and you say, okay, well, let's look at their charts and see how bullish their charts are. Something like Kohl's is one of the top stocks today. You can see, this is where it's at. Now, if this breaks out here, look at the move that it can make. It was before this decline. It wasn't really bullish, but it was at least at $45 a share, and now we're down to below 20. So if it breaks through and gets back to even back to its, not even the 52-week highs, but just to its pre-breakdown highs, that's a really big gap to fill. The question is, how likely is that to fill that gap? Even you look at its market forecast chart, and you can say, okay, it's one thing to buy Amazon right now, but it's another thing to say, oh my goodness, that's a bullish pattern, light green shading and a yellow line. That's a bullish pattern there. Is this kind of a sucker rally move in the midst of a downward cycle, down to the left cycle of relative strength, where we have the opportunity, or kind of a rare opportunity to sell that. I mentioned Amazon. You can see, for the second time in the last week, we've gotten a bearish cluster pattern. This first one was a pretty big bearish cluster pattern, and we kind of tried to fill in the space, but then today we have a cluster of the last couple of days. So, and again, kind of after these overbought clusters, a bearish divergence, and this has been a market leader, right? If I add Amazon onto this one, this is one that does look good, right? So it is one of the stocks that has been, here, let's go to the weekly chart, that has been a leader, right? Look at that. It's a big move. Where everything is down to the left right now, it's a big move to the right. So we like it. That would be the one that we want to lead in, and that's giving us a pretty bearish candlestick pattern. So you can kind of see this is what we want us to lead, because it has been leading. The other stuff that's leading has not been leading, and not only that, but even in the short term is cycling down. So one day doesn't break that down to the left, up to the right cycle that we are currently in the down portion of. So it'll be interesting to see if we can take advantage of that move in either direction here. And that brings us to our trade idea of the day, which again, when you look at Tesla on its market forecast chart, it does got the overbought cluster on the beginning of a bullish move. We've traded a few of those here lately. So it did finish with the cluster today. If you look at some of these other charts for the confirmation signs, it is above its value area, well above its point of control, and breaking up today out of this little consolidation and above this volume node. Still in the upper half, lots of space to fill. If you take a look at its DMI, it is above the 30 level, right? It had pulled back down, and it's still back above, and you can see the negative is back below 25. So still a bullish pattern there. I remember these patterns, the bullish patterns widen out at the end of the runs. The bearish patterns start bigger and finish smaller. The bullish patterns start smaller, finish bigger. So here we are starting relatively smaller compared to what we've seen in the past, with opportunity to get bigger at the end of it. You take a look at its Ichimoku cloud and trend strength indicators, you can see we are above 5 and we are above 80. So we're above the cloud, and we're rising on this trend. So you look at its RSI and CCI, all the things that we want to see from the S&P, we have seen. Tesla did get above 60 and already has pulled back down and bounced back up and has held so far. It did get above positive 200 here. So it's setting up, it can run into some resistance here, but it's also setting up for a good move to the upside. So especially with earnings this week. So is there a way that we can trade this? So if it does break down hard, we can take a small loss. But if it does break out to the upside and gets closer to these highs, if not through it, and the market itself continues to trend higher, then we can make a lot of money with this. And of course there is. And what we can do is we can come out to this May expiration, and we can look to buy, in this case, buy the 980 call option, which is costing a lot of money to do that. But we're going to offset. Whoops, that's in June. Sorry. So let's go out to May. So we'll buy the 980 call option, if I can get to it here. So many strikes. 980, which is kind of an interesting what the market maker's thinking about the stock. So buy the 980, and we're going to sell the 990, because again, that's the 1,000 level is kind of where kind of a magic number is for it. You know, if it can get up there, great. If it goes beyond there, then we've got a good return by the time we get there that we'd be more than satisfied with. Very directional play, so it cuts the cost down. You can see ultimately we've already done this trade. Here we go, put it into the market outlook category. We've already done this trade earlier today. We were able to get keep this within a small risk, so this is about half of what a normal risk is because of the directional earnings. Here is the 1 standard deviation move by May expiration. There's your maximum gain inside of that. This shaded area is going to shrink after volatility comes down after the earnings. So the question will be whether the green level will stay in there after the earnings. And if we go down on the earnings, then see, we take a very small loss. If we go up on the earnings, you can see we get a really decent reward, almost 7-to-1 in the worst case scenario. And even better than that, obviously, if we can cut the loss in half, if we get some kind of smaller loss after this earnings announcement. So a very low risk way, low probability, but a good reward potential and a low risk way of getting of trading earnings, the earnings announcement. Again, guessing on a break to the upside because of all the technical signals that this stock is showing that we would be loved to see showing up on the broad market as a whole to confirm this little bounce is turning into more, it's actually turning into a trending move. You can see the golden cross after pulling down, bouncing up. With a really high PPO like this sets up for the potential for a divergence, which means actually going up to a higher high than this one. And that's the other thing that plays into this type of move. You can see, again, higher closes, and as of right now, a higher high, and potentially closing up above those highs would be really bullish. So there's something to keep an eye on for Tesla, in a really good way to get a good reward for the risk that we're taking. All right, you've heard from me now. Now we want to hear from you. Use that link popping out in the top right corner of your screen. That will take you to our Market Outlook forums where you can ask any questions or comments, reply to anybody else's, and kids, keep this conversation going within our community of people who are watching this video just like you are. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon down below, comment on our video on anything that stood out to you. Follow me on Twitter for more content between these videos, and join our Market Outlook Facebook group, as well as our community at marketscholars.com. Again, thank you. Have a great rest of your Monday night, and we'll see you all next time.